aircraft leasing companies are undervalued. This is going to be an interesting video today. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. So today we're going to be analyzing FLY, the ticker symbol, and AER. I've actually done a previous video on AER. Now, both of these are aircraft management and leasing companies. So they are not airlines. Rather, they lease out airplanes. They do buying and trading of airplanes and management. They both appear from their fundamentals to be dramatically undervalued. And it's a really interesting business because both are legit businesses and their numbers just are really interesting, especially looking at their balance sheet. So let's go ahead and check out the numbers. Now, first off, we have AerCap Holdings, Inc. It's currently valued at $3.98 billion. It's actually the largest aircraft leasing company. It acquired International Lease Finance Corporation in 2014, and it's headquartered in Ireland, which is pretty interesting. So it's currently trading at $30 a share, and that'll come into play in a little bit here. Now, the next one here, which is a smaller one that actually a viewer recommended me to do a video on, is FLY, ticker symbol FLY. It is FLY Leasing. Now, this is a much smaller leasing company. Its market cap is only $223.39 million, and its PE ratio is only 1.28, which is really interesting, and it's currently trading at $7 a share. Now, this is also based in Ireland as well. Most of these aircraft leasing companies seem to be based in Ireland, which is kind of interesting. Some are based in Canada, I believe, as well. Now, let's keep going ahead, and the first thing we're going to do is analyze FLY Leasing's finances. So we're going to start with FLY, and then we'll go on and do AER after that and kind of compare the two, and you'll see why this it just gets really interesting. So first, if we look at FLY's balance sheet here, and this is just for Q2, if we look at total revenue, you can tell that total revenue, well, it declined slightly, and that is the 6 month, by the way. There's 4 columns here. The ones on the right is the 6 month, and the one on the left is the quarter for 3 month. So I'm kind of been looking at the 6 month. I just believe that longer time frame helps us give more of an example of how this company's doing, rather than just one quarter, especially since last quarter is just such a strange quarter. Now, total revenues were $200 million. From the last time, it decreased from $281 million. And it says 200,000, but it is in thousands of US dollars. So 1,000 times 200 is 200 million. Now, if you go down below, net income decreased to $47 million, just over that, $47.678 million. And that decreased from $99 million. Now, that's still a pretty good amount of net income to be making. I mean, making about $50 million a year in net income, and that's for 6 months. So you double that's about $100 million. And now, if you look at their market cap, it was just over $200 million. So that's why their PE ratio is so small. It's like if we can go ahead and look at it here, it was 1.28. So it's a really, really small PE ratio, which we're really not used to seeing in a lot of stocks these days, especially with all the tech companies booming right now, etc. We're used to seeing these 200 PE ratios, but to find a 1.28 PE ratio, especially for a company that, although it's not huge, it's also it's a pretty fairly sized $200 million company. Now, it gets more interesting from here. So if we look at their total assets, they currently have about $3.5 billion in total assets. But then we have to take liabilities into account. So if we add up all their liabilities, we see total liabilities. That's $2.6 billion in liabilities. Now, if we subtract the two, we get what's called the shareholders' equity, which is what's left over after you subtract the liabilities from the total assets. And that's $898 million. Now, you may already notice this. That's significantly more than what the stock is currently worth, what the market cap of the company is. So it has $898 million in shareholders' equity. That means it has assets worth $898 after subtracting all your liabilities. However, the company is only trading at or worth $200 million. That doesn't really make much sense, does it? And if we do some calculations here, again, we took the shareholders' equity of $898 million, and we take the outstanding shares, so we divide it, and we get $29.46 a share. So again, that is the shareholders' equity divided by the total outstanding shares, which is 30,481,069. And we do that math there, we get $29.46 cents a share. However, the current share price, what it's trading at, is $7.31 a share. So it's over a 200% gain to reach the stock's what we call the book value of this company. Now, the market cap is currently around $225 million US dollars, but shareholders' equity is $898 million. And their cash and cash equivalents alone is more than the market cap of this company, which is $288.98 million US dollars. So for this company to be trading at $7.31 a share with a PE ratio of if we go back and just look at it here, what was it again? 1.28, to have more cash than its market cap by a pretty significant amount, as well as its book value being $29.46 a share, makes this company extremely undervalued. Because if you were to buy preferred shares, which preferred shares are if the company was liquidated, and once it's liquidated, like let's say the company is in trouble, it liquidates all its assets to pay off all its debt and everything, well, you're going to be left with a bunch of money, and all that money is going to go to you because you are the preferred shareholders. You're going to get all that money before just a regular common stock shareholder. Now, anyways, what's important about that is if you were to buy this company at this price, let's say you bought the whole company and then you liquidated the company, well, at this price, you'd make a pretty significant return on your money just by liquidating the company. So now let's go on to AER, because there's a very similar situation with this company, but this company is much larger. The other one was only $200 million. This one's $3.98 billion. Now its P ratio is 3.65. It's also a little higher, and it's also trading at a significantly higher share per share price, even though the market cap is higher. So the ratio doesn't matter too much there. But anyways, $30 per share for this stock right here. Now it's already nuts. They have $12 billion in sources of liquidity. They have $27 billion in unencumbered assets as of the second quarter of 2020. Now, $27 billion of unencumbered assets. What does that mean? So unencumbered essentially is, to just dumb it down here, what it means is, let's say you have a house, you take a loan for the house and you pay off that loan, now you own the house. That would mean unencumbered asset. Or let's say you take a loan out for a car, then you pay off the loan, now you own the car. That is an unencumbered asset. They have $27 billion worth of unencumbered assets. Remember what their market cap is. $3.98 billion. And then $27 billion of unencumbered assets. That doesn't really make much sense, does it? And then their average current lease. So the worry would be, okay, let's say a bunch of, airlines aren't flying anymore. They no longer need to renew their leases. Well, the average current lease expires in the fourth quarter. So at the end of 2027. So we have years till we have to worry about these leases expiring. On top of that, we have a debt ratio of just 2.5 to 1, which is pretty solid, especially for an aircraft leasing company. And if we're going to keep going ahead and I'm going to read this thing, kind of see how the company is positioned during COVID, just in case if there's something else going on that we're kind of missing. So let's go ahead and read this statement from, I believe this is the CEO of the company. Yeah, Chief Executive Officer. So the COVID-19 pandemic continues to create significant challenges for the global aviation industry and our airline customers, said Angus Kelly, Chief Executive Officer of AerCap. In response, we've maintained a record amount of liquidity and strong access to funding. We currently have 12 billion sources of liquidity, which is more than double our cash needs over the next 12 months. Since April, we have raised $3 billion of new funding and have over $2 billion of additional funding initiatives in progress, with $27 billion of unencumbered assets, a record low leverage ratio of 2.5 to 1, and an unrivaled operating platform. We are well positioned to weather an extended period of turbulence and support the recovery of the airline industry in the future. Now, that's an incredibly positive and optimistic statement. They're basically saying we have tons of money right now. We're prepared to withstand anything for, at least the short term, especially, and we're going to support the airline industry as it continues to recover, which we are seeing it start to slowly recover over time right now. Now, if we go ahead and look at some other information here, we can tell that their total revenues and other income, although it did decrease slightly from the last 6 months, which ended in 2019, now 2020, it decreased from 2,486 to 2,436. That is in billions, by the way, since this chart, those numbers are in millions. Now, basic leased rents were $948 million for the second quarter of 2020, compared with this is just $1,077 million for the same period in 2019. The decrease was primarily due to lease restructurings, transitions, and the impact of airline bankruptcies. That's great that they're being transparent there and explaining, okay, yeah, we saw a decrease, but here is why. It wasn't just, we don't know why, maybe there's something else going on with this company. They literally just lay it out for you, and I love that about a company, just saying lease restructurings, transition, airline bankruptcies, just completely laying it out for you. That's what you like to see in a company, especially with this sort of confidence. Now, maintenance rents and other receipts were $224 million for the second quarter of 2020, compared to the $109 million for the same period in 2019. The increase was primarily due to higher maintenance revenue recognized as a result of lease terminations during the second quarter of 2020. So that's interesting. Even though some leases were terminated, or they had, airlines, they aren't flying as many planes at the ground their planes, well, they're charging maintenance receipts. They're charging for that and for those lease cancellations. And as you can tell, a lot of that, even though they had a decrease in their basic lease rents, basic maintenance rents and other receipts increased about twofold, which is amazing that they can make up for the loss of revenue from other segments of their company. Now, net gain on sale of assets for the second quarter of 2020 was $10 million, relating to 9 aircraft sold for $188 million compared with $78 million for the same period in 2019, relating to 22 aircraft sold for $502 million. The decrease was primarily due to the lower volume and composition of asset sales. That makes sense. It doesn't seem like many people would want to buy an airplane right now, especially many companies who are going bankrupt, struggling. While in 2019, the economy was thriving. They're probably trying to grow their business, etc. So that just makes sense to me. Not a big surprise. Other income for the second quarter of 2020 was $15 million compared to $17 million for the same period in 2019. Just a small decrease there. Now let's go ahead, and I know this chart is really small to see, so I'm sorry about that. You might have to zoom in here to read all the numbers. But again, if we look at maintenance receipts, it grew as we were talking about. Expenses also grew slightly, but revenue, sorry, I'm trying to squint to see this right now. And net income, it decreased slightly as well, but that's kind of what you'd expect, and they already explained why that is. Now, again, the interesting thing here is how much cash they have. They have over $2.6 billion in cash right now, an increase from $970 million at the same time in 2019. So $970 million to over $2.6 billion in cash and cash equivalents and restricted cash at the end of the period now. And again, if we go ahead and this is a kind of a similarity to what you're going to see with FLY, is total assets and total liabilities. Total assets here is $45 billion, total liabilities around $35 billion. So if we do some basic math here, shareholders' equity, which again is total assets minus liabilities, we're going to have an outcome of $9.7 billion US dollars. Now, total outstanding shares, significantly more outstanding shares than FLY, 129 million. 672,783 shares outstanding. So we do the shareholders' equity divided by the outstanding shares, and we get $74.82 a share. Now, the current share price is $30.58 a share, and it actually was trading as low as about a week ago, below $30, around $21 for a while there. Kind of been fluctuating between $25 and $30 for quite a while now. Now, that's a 150% gain around that to reach the book value of $74.82 a share. So again, if you were to buy up a bunch of preferred shares of this company, or let's say you're a big private equity firm, you come in, purchase this company, and then you liquidate the whole thing, you're going to make, around 100% gain on your money just for liquidating the company, because once you pay off all the liabilities, you have this insane, you need $9.7 billion in equity to deal with, just assets after all the liabilities, which is an incredible amount. So again, the market cap is $3.97 billion, but the shareholders' equity is $9.7 billion. And they already have 2.382, around that 2,382,655,000 in cash and cash equivalents alone. Now that's not more cash than its market cap like it was for FLY, but that's still a significant amount of cash. It's almost, about $1 billion less than its market cap, which is an incredible amount of cash. So to have, that big of a difference between its shareholders' equity and its market cap, in my opinion, makes these companies incredibly undervalued. We have to ask the question, why do they appear so undervalued? Don't other people see this? Aren't other, investors taking advantage of this? What's the deal here? Well, why do they appear to be so undervalued? Well, the main thing is that investors fear the airline industry right now. If companies were to go bankrupt, they can break lease agreements, as we were saying, or they could have a bunch of issues. But it seems like this company has handled those lease agreements breaking very well with the maintenance fees. And assets are nice, but if you can't liquidate them, because let's say someone buys this company, they plan to liquidate it, but no airline wants to buy airplanes right now. Well, there's no really a point in having those assets if you can't sell them and turn it into cash. So what's really the point then? So that's kind of a fear as well. And they're just not popular stocks. These companies, they kind of operate behind the scenes. When you think of airline stocks, you never really think of leasing companies and, aircraft trading companies and management. You really just think of airlines, Southwest Airlines, you're thinking of Alaska, whatever it might be, all those big airlines, JetBlue, you never really think of these leasing companies that are operating behind the scenes. In my opinion, this is kind of a cigar bud stock, as Benjamin Graham might say. And that's because of just how big its assets are compared to its liabilities. The book value is just so much higher than what the stock is currently trading at. Will we ever see these stocks, bounce back to the book value or above that, like they were trading at previously before the whole pandemic hit? Who knows? It's really hard to tell. I can't predict that. I'm not going to make any drastic decisions for you, but I do think these companies are super interesting to follow. And if anyone can do more research or finds new information on these companies and why they're trading significantly below what they appear to actually be worth, go ahead and comment it down below. I would love to hear that. So anyways, thanks for watching. Please subscribe. I hope you enjoyed this little quick analysis here of these airline leasing companies. I just thought this was super interesting. Make sure to check out these videos as well and follow me at StockerFinance on Twitter for more information. Anyways, guys, my name is David Scheuer. I will see you guys in the next video. Peace out.